we've had 2 days in a row now of elation from the traders. The day before, when we crossed 1,000, everyone was cheering, and then yesterday, when it suddenly turned positive with about 15 minutes left of trade, again, everyone cheering on the floor.
Don't you think
the speed of the turnaround was unbelievable?
The pain should be shared. I mean, I don't want to say. I just don't want to say. We don't want to be bullish. You know, when we're just covering the stuff, we don't want to be bearish. Although we have an inherent bias, probably. We like prosperity. We like things that go up. But when the bulls, so much pain has been inflicted, and so much, you know, think about the last 2 months of some of those days. Another day down 500 points. Where
I've kind of experienced.
It's fun when the shorts get squeezed, isn't it? Fun when they get. How's that feel?
So, Wilford, they were cheering the 1,000-point rally, so the machines were not bad. On Wednesday and yesterday.
That's what I wanted. That's what I said yesterday.
Okay. So the market went up the last 2 days because
this is one of the guys that likes it when it goes down.
We recognize the fundamental strength of the businesses, but when the market goes down, it's the algos and the machines.
The tax cuts worked yesterday.
To mention the point of the machines, though, on Monday, all sectors were lower. On Wednesday, they were all higher, and yesterday they were all lower and then all higher by the close. So it is definitely a week where the machines have played a role, not just company earnings or fundamentals.
I'm sorry.
You can't dismiss this also on volume, because the volume was actually pretty strong yesterday. We had 9 billion shares compared to 9.2 billion, which is the 20-day moving average. So
even Christmas Eve was not bad.
Right.
If you think of it from a portfolio standpoint, you look back at 2017, and basically everything went higher. It was a low volatile year. You basically had a high beta. Everything went up. Then you think about 2018, it was a low beta year. Everything basically went down. In an environment where everything goes down, from a portfolio standpoint, diversification obviously is important, but also rebalancing. And what has happened is at the end of the year, you've been provided an opportunity as a portfolio manager, because now you see a 10-year at 275. Who wants to buy it? You know, who wants to buy bonds with a 10-year at 275? You see equities pull back 15%. Here's your rebalancing opportunity. I think that's a lot of what's. I think a lot of that's coming into play here.
Who's got the nerve to step in? That's the problem. And after 1,000 points that day, everybody said, "Watch, this is fake. This is the biggest fake rebound ever." And then it looked like that was confirmed yesterday. But before, and it's like people that were still not going to get in, not buying the bottom, not buying the dips. They're like, "See, I was right. We're down 600." And then they go have a sandwich and they get back. And I mean, that's the diabolical way the market keeps people out. Now, I don't know if this is over. I don't know if we're headed higher from here.
It takes years. I mean, it takes years to bottom typically.
But
I mean, it's not going to be 3 trading days. It's not going to be 2 trading days.
1,300 points in 2 days is how much.
Well, but Joe, just to your point quickly, I agree. 10-year at 2.75 doesn't seem attractive. But cash,
better, doesn't it?
Cash you can get over 2% on if you're buying a CD. And Jim Cramer was making that point yesterday for certain investors of a certain age. That is attractive relative to buying stocks when you've seen this volatility.
I agree with Jim's analysis, but when you see assets decline the way they have in the last 8 weeks, without knowing the statistics, I would make the argument that cash levels are certainly higher today than they were 8 weeks ago. Sure. So there goes the rebalancing opportunity and the redeployment of capital.
I don't want 2%. Keep your 2%.
Well, if you're 65, you want 2%. You're looking at
capital. Look at me when you say that. Don't look at me.
Did you see the? 65.
Yeah, but even at 33, I have to say, in my whole life since I've been out of school and may have had any opportunity to save.
You're talking about.
My point being, the last decade.
We're talking about months.
The last decade, I couldn't.
We're talking about months.
I couldn't possibly save money. There's been no point because it's been zero, and now you can actually get something.
Did anyone notice the Japanese bonds? There's zero.
They're negative.
Yeah, or close to negative. So, does that sound good to you?
I'm not going to save my money in Japanese bonds.
The yield curve, global.
Do I represent Japan today as well?
Yeah.
There we go. They're negative.
I mean, that happened. Yeah.
Joe, that's distinctively a much different economy than what we have.
I'm not saying it's not. I'm just saying that yields around the world are still not better than equity. You're still better off.
The rest of the world looks nothing like the United States
even if you are in your early 50s or whatever, mid 50, whatever you happen to. You looked at me when you said so. But even if you are there, I still think. I mean, 2% for 10 years, Wolf? 2 3/4 for 10 years?
No, not for 10 years, but you can put it in a 1-year CD. Okay. That's slightly different.
All right. So you put.
You don't want to go
which
long
talks to the
duration
flatness
CDs.
of the yield curve and the whole aspect of whether people believe this growth can last. But nonetheless, If you can get over 2%.
You know that on $10,000, you can buy like a six-pack after a year on the interest or so. I mean, is that
well?
too
You used to be able to buy half a beer. Now you can get 6.
Right. There have been times where you're just happy to get your money back.
Right. Or you can be down 9% for the month of
exactly.
December.
Well, that's
so,
the thing. That's the thing. Cash has been better for 2 months. Cash has been better than stocks, but
for the year.
For the year.
For the year,
well,
cash has been better than stocks. But for the year, cash has been better than any asset class around
really
the
2
world.
months before that, we were.
The other thing to point out as well is that the U.S. equity markets have been a lot better than the rest of the world.
On a relative basis,
it feels,
sure.
they should be.